In the investment world, there's a very strong and very persistent belief that companies that have historically achieved or are expected to achieve relatively high rates of earnings growth deserve a higher PE multiple than companies that have achieved or are expected to achieve relatively lower rates of earnings growth. This is a myth. And in this video, I'm going to explain exactly why that is. There are many reasons why companies that achieve relatively high rates of earnings growth don't necessarily deserve a higher PE than companies that achieve relatively lower rates of earnings growth. I'm going to go over 5 of these reasons. Now, the first reason I'm going to go over has to do with the fact that many companies achieve higher earnings growth simply because they pay out a lower share of their earnings in the form of dividends. If a company pays out a very low share of its earnings as dividends or doesn't pay dividends at all, then it has more money to reinvest in the business and generate growth. However, there is something called the dividend irrelevance theorem, which states that the value of a firm doesn't depend on or is not influenced by how the company chooses to distribute its profits. According to this theory, the value of a firm depends on its ability to generate profits. Now, how the firm chooses to distribute those profits is irrelevant to its value. Now, that's the theory. And there's huge debates about this. In fact, this theory is one of the most important, one of the most fundamental theories in all of finance. And it's still debated to this very day. But I think that there's a few points related to this theorem that we can all agree on. If a firm reinvests a portion of its profits and merely earns its cost of capital or the required rate of return, or a rate of return that's lower than the cost of capital, then in the former case, there's no value created, and in the latter case, value is actually destroyed. So by reinvesting earnings into the company may be able to achieve a higher rate of earnings growth, but that won't actually add value. In fact, if it doesn't achieve a rate of return that is at least as high as the company's cost of capital, the company is destroying value, and therefore that company that actually has a higher growth rate actually deserves a lower PE multiple than a company that distributed more of its profits in dividends and achieved a lower growth rate but didn't destroy value. That company actually deserves a higher PE ratio. Now, this isn't just a theoretical argument, because a lot of empirical studies have proven that over the course of history, most firms that retain a high share of their profits to reinvest in the business don't achieve a rate of return that is equal to the company's cost of capital or cost of equity. Companies generally earn below their cost of equity, meaning that they're actually destroying value by growing. There is any number of industries that I could point to that many of you are aware of that have simply overinvested in order to try to achieve growth, and they actually have achieved some level of earnings growth, but that earnings growth is not enough to compensate for the investments that they made. If a company achieves a higher growth rate of earnings by paying out a lower share of its profits as dividends, that company doesn't necessarily earn or deserve a higher PE ratio than a company that pays a higher share of its profits as dividends and therefore grows less. In fact, if the company that retains a higher share of its earnings earns a rate of return on those reinvested profits that's lower than its cost of capital, it's actually destroying value as a result of growth. And that means that that company actually deserves a lower PE ratio than the company that has a lower earnings growth rate. The second reason I'm going to go over in this video is really attached at the hip with the first point. And that is that growth is expensive. There's no such thing as a free lunch. When a company tries to grow, in order to grow, a company generally is going to have to invest capital. It's going to have to invest money. It's going to have to hire new workers. It's going to have to build new property, plant, and equipment. Achieving that growth is expensive. So it's relatively easy for a company to spend money by either reinvesting its profits or by, let's say, borrowing money and throwing money at projects in order to show growth. But the question is the company earning at or above its required rate of return or its cost of equity? If it's not, then this company that is actually growing its earnings actually deserves a lower PE multiple than if it hadn't grown its earnings at all. This is a very, very important point to understand. And it's really kind of the central point in this whole video where I'm talking about why it is that higher growth doesn't necessarily deserve a high PE multiple. The only time that higher growth of earnings deserves a higher PE multiple is when a company achieves what we call abnormal earnings growth. And in a separate video, I'm going to talk in detail on exactly what abnormal earnings growth is. But just very briefly, abnormal earnings growth is a growth rate that's achieved that is higher than the normal growth rate. And what is the normal growth rate? The normal growth rate is the growth rate that you would expect if a company makes incremental investments and earns a rate of return that is equal to its cost of capital. When a company makes incremental investments and earns a rate of return on those investments that's higher than its cost of capital, then it generates abnormal earnings growth. Only abnormal earnings growth creates value. Other types of earnings growth that are generated from investments that don't earn the cost of capital are actually destroying value. And therefore, a lot of companies that are actually showing a lot of earnings growth are actually destroying value and actually deserve lower PE ratios than companies that grow at a lower rate but are not destroying value, or that might actually be reinvesting some portion of their profits in their business and achieving a rate of return on those reinvested profits and on incremental capital that's invested, which is higher than their cost of equity. In that case, those companies will deserve a much higher growth rate, and a much higher PE multiple than companies that have a much higher growth rate. Very important to understand. The third point that I'm going to go over in this video is that growth is risky. Again, there is no free lunch. If a company wants to attain a higher rate of earnings growth, it's generally going to have to assume higher risks in order to achieve that higher earnings growth. Now, companies that increase their risk profile by taking on riskier projects actually increase their cost of equity. The required rate of return for that firm actually increases. And all things being equal, a company that has a higher risk profile and that therefore has a higher cost of equity actually has a lower PE than a company that has a lower risk profile. Now, if a company actually earns a higher rate of return on these new projects than it was earning on the businesses that it had in the past, then those investments will be justified. But it won't necessarily mean that the company deserves a higher PE, because you have to remember the hurdle rate on the new investments is higher. So they don't just need to earn a higher rate of return than their old cost of equity for their old, let's say, mature business that was very secure and produced steady and relatively stable and relatively safe profits. On their new projects, they don't need to earn that rate of return. They need to earn a new higher rate of return on those incremental investments. And if they don't do it, they're actually destroying value. So again, this would be a case in which a company might actually grow their profits at a higher rate. But if they do so by taking on riskier projects, they may actually be destroying value. And therefore, a company like that actually deserves a lower PE ratio than a company that chooses to avoid investing in risky projects and has a lower earnings growth rate, but that company will actually have a lower cost of equity. And a lower cost of equity necessarily means a higher PE ratio. So again, in this case, this particular company that I just mentioned that has the lower growth rate will deserve a higher PE ratio than this company that invested in new risky projects, took on greater risks, and therefore the overall cost of equity of that company has risen and its normal PE will actually have fallen. The fourth point I'm going to go over today is that many companies achieve higher earnings growth by increasing the amount of debt on their balance sheets. Now, higher earnings growth that's achieved through higher debt doesn't actually add value and doesn't actually merit a higher PE ratio. In other words, if a company has increased its growth rate through higher debt, it doesn't deserve a higher PE ratio. Now, again, there is a very important theory in finance called the capital structure irrelevance theorem. And what this says is that a company cannot add value or subtract value by simply adding debt or by lowering the amount of debt on its balance sheet. The amount of debt that it has or the ratio of debt to equity that it has doesn't actually make any difference to value. Now again, some people debate this point, and there's also some exceptions which the authors of this point, Modigliani and Miller, readily recognized. And I'm not going to go over all that because that's going to be getting very highly technical. But as a very general matter, I think it makes intuitive sense. Everybody that's watching this video can kind of understand that all other things being equal, if a company achieves higher earnings growth by taking on a lot more debt, that's not necessarily going to make that company more valuable. Now, it would only make it more valuable if potentially, by the way, if the investments that it made by taking on this new debt earned a rate of return that was greater than the firm's cost of capital. In that event, the firm might actually deserve a high PE ratio. But according to, I would say, the consensus of experts on this, that's not necessarily the case. And the reason is that by taking on a greater amount of debt, the company has actually increased its risk profile. It's become riskier. And you can actually do the math, but by taking on a higher amount of debt, the volatility of the company's earnings actually increase. And so there's actually a mathematically symmetrical relationship, and I can't get into that here, between the volatility of the earnings of a firm and its debt to equity ratio. And so the idea being is that if a company takes on more debt in order to achieve higher earnings growth, and it actually manages to do it, that's going to be canceled out by the fact that the company has increased its risk profile by increasing its debt equity ratio, by increasing the volatility of its earnings. Therefore, that particular company now has a higher required rate of return on equity capital. It has a higher cost of equity now as a result of taking on more debt. And again, the normal PE ratio is determined by the cost of equity. Anytime the cost of equity increases, the fair value PE ratio decreases. So again, here's a case where a company may actually achieve higher earnings growth, but if it did so by acquiring more debt, it won't necessarily, and in most cases, we should assume that it won't actually add value. And in fact, it may actually destroy value, because unless the firm is earning abnormal profits by increasing the amount of debt on its balance sheet, it really needs to earn like a lot more to compensate for the fact that the firm has become more risky. So, very important point to understand. if a firm obtains higher earnings growth than another firm because this firm has increased its debt while the other one hasn't, this firm that has a higher growth rate may actually deserve a lower PE ratio than the firm that has a lower growth rate. The firm with a lower growth rate may actually deserve a higher PE ratio than the firm that has a higher earnings growth rate. The fifth point I'm going to go over has to do with share repurchases or stock buybacks. A lot of people in the market think that companies that repurchase a lot of their shares, that do a lot of stock buybacks, deserve a higher PE multiple than companies that don't do stock buybacks or just do less of it. And the intuition behind this idea is that when a company buys back its shares, the share count of the company will fall, and therefore the earnings per share of the company will grow. And therefore, again, we're back to this idea that as a result of a company having higher earnings growth, in this case through share repurchases, they actually deserve a higher PE. Well, that's not the case at all. And there's two very important reasons why. They're actually very different reasons, but very important that you understand this. The first reason is that most companies, not all companies, but most companies that repurchase a lot of their shares are not actually reducing their share counts. Why? Because the reason that they're repurchasing their shares is to simply cover up for the fact that they've made a lot of stock option grants to the employees. So when a company grants a lot of employee stock options, the share count actually rises. So in order to avoid earnings per share declining, in order to avoid this dilution, companies repurchase shares, and usually it evens out in the vast majority of the cases. And if we look at the aggregate of the entire market, all this propaganda about share repurchases, turns out that it's really just covering up and compensating for all the shares that the company has issued to its top executives. Now, I'm not saying that that's a bad thing or a good thing. I'm just stating a fact that in most cases, share repurchases are not actually lowering the share count and therefore are not actually increasing earnings per share. Now, what you have to actually examine is if companies are actually getting their money's worth from the enormous cash outflows that they're essentially spending in order to enable these stock option grants. Is the company earning such a higher rate of earnings growth and such a higher return on its investments that it justifies these massive amounts of cash that the company is spending in order to repurchase the shares? I'll leave that up to you, and that's something that's on a case-by-case basis. But now let's go on to the second point. Let's now assume and give certain companies the benefit of the doubt and say, you know what, the majority of their share repurchases actually lead to share count reduction. In that case, if the company's share count lowers, that's going to increase earnings per share. Shouldn't that be awarded a high PE ratio or a higher PE ratio as a result of that higher growth? Absolutely not. To understand this, just think of this. Imagine a company comes and uses its cash to go purchase the shares of another company, of a separate company. Now, the only way that the purchase of that other company is going to add value to the purchaser is if the company is able to purchase those shares at a price that's below the intrinsic value, that's below the fundamental value of the firm that's purchasing. That's how it adds value. If it actually goes out and buys a company at a price that's higher than its fundamental value, then that company is actually destroying value. And so even though it'll actually grow its earnings by purchasing that company, because when you purchase that company, that's going to add to the earnings of the firm, right? And that'll cause earnings growth to rise. But there's actually a destruction of value going on there. So a company that actually does that actually deserves a lower PE ratio. And this isn't just theoretical, because again, empirical studies have shown that in the majority of cases, acquisitions don't actually add value. When all is said and done, the mergers and acquisitions that companies make, the enormous amount of capital that companies spend on purchasing other companies, when the accounting is done, at the end of the day, it turns out that those purchases didn't earn the cost of capital. Value was actually destroyed. And so companies that are serial acquirers and that tend to make acquisitions that are too expensive actually deserve a lower PE ratio. And in fact, some companies that have gotten that sort of a reputation actually do have a lower PE ratio. A company like AT&T comes to mind that made a ton of acquisitions, acquired a lot of debt to make those acquisitions, but those acquisitions didn't end up generating enough profitability to actually justify the purchase price. As a result, value was destroyed, and the company now is saddled with a lot of debt and trades at a very low PE ratio. Now, at first, a lot of people were excited about some of these purchases, and they thought that purchasing these other companies was going to increase the growth rate of AT&T, and so people started bidding up the shares of AT&T and had a higher PE. But experience showed otherwise, and history has shown that more often than not, this is the case. Now let's get back to the idea of share repurchases. It's the exact same principle. If a company repurchases its own shares at too high of a price, if it repurchases its shares at a price that is above its fundamental value, then the company is actually destroying value, and it actually merits a lower PE, even though it's going to achieve a higher earnings per share growth rate. Now, there's this whole issue of, well, what do you mean that if a company repurchases its shares at a price that's above its fundamental value? This is very common. And this is the really weird thing, that companies actually repurchase their shares more often when stock prices are high than when stock prices are low. That's completely irrational. In theory, companies should deploy their capital to repurchase shares when their stock gets really cheap. But that's not actually what happens, because stocks get cheap when times are tough and companies are afraid of spending money, so they don't actually spend money on much of anything during tough economic times, when there's a recession, when companies are having trouble. So they actually miss an opportunity to buy shares in a way that would add value to the company and would therefore, in a sense, boost its PE ratio, because when a company is able to acquire another firm or its own self at a price that is lower than the value that it has, then that adds value, and therefore that increases the fair value PE for that company. But the reality is very different. Usually what happens is that when the economy is booming, when companies are very profitable, and when the stock market is booming and stock prices are high and above what their fundamental value is according to fundamental analysis, that's when companies are purchasing these shares. So companies like, for example, to just name one, Apple, that's out there purchasing a tremendous amount of its shares when the company is trading at over 30 times earnings, its growth rate doesn't seem to justify that type of PE multiple. Apple is a company that has relatively mediocre growth, but has a really high PE ratio. Now, some of the growth that it actually achieves, a pretty big chunk of that growth, is actually achieved through share repurchases. But when it's repurchasing its shares at such a high price, it very well may be that in the long run, we retrospectively are going to see that Apple was destroying value by repurchasing shares at such high prices. So again, companies that grow their earnings by repurchasing their shares at expensive prices actually deserve a lower PE than companies that choose not to repurchase their shares at high prices and therefore don't destroy value. Those companies that are more disciplined in the use of their capital deserve a higher PE, despite the fact that that means that the company will have a lower growth rate. Again, another example, companies sometimes that have lower growth rates deserve higher PE multiples than companies that have higher growth rates but are achieving those high growth rates through bad decisions, such as repurchasing their shares at expensive prices. So let's briefly review. In this video, I showed you 5 examples where companies that have relatively high earnings growth rates actually deserve lower PE ratios than companies that have relatively lower earnings growth rates. Or put a different way, I showed you 5 different examples where companies that have relatively low growth rates deserve higher PEs than companies that have relatively higher growth rates. Now, this is counterintuitive to a lot of people because people have been fed this myth that higher earnings growth rates necessarily deserve higher PE ratios. But just from these 5 examples that I showed you in this video, you can see clearly that this isn't true. In order to see what sort of a PE ratio a company deserves, you have to analyze that firm on a case-by-case basis. You have to look, first of all, at what the company's cost of capital is, because that's what's going to determine their normal PE. And then the second thing you have to look at is to see if the company is actually achieving abnormal earnings growth. Not just achieving earnings growth or high earnings growth. It doesn't matter if the earnings growth is high or low. What matters is if it's abnormal. Abnormal means that incremental investments are generating a rate of return that's greater than the firm's cost of capital. When growth is being generated that way, then the company deserves a premium to its normal PE. All right? Very, very important to understand. And then in the next few weeks, I'm going to be actually looking at various sectors of the market and applying this sort of analysis to see if the PE of companies in that sector are perhaps too high or too low or fairly valued. And we're actually going to be looking at individual stocks and individual companies, particularly some of the biggest and most important stocks in the market, like Apple, Microsoft, Google, Meta, Nvidia, etc. We're going to look case by case, in fact, in separate videos we're going to be looking at case by case at these 7 stocks that form the Mag 7 and analyzing whether they're trading at PE ratios that are justified, whether maybe those PE ratios are too high or maybe they're too low. So stay tuned to this channel, subscribe to this channel, and the other thing that you should do is to sign up to my free newsletter where you can become part of a free community where I discuss these sort of issues, and I will be discussing these sort of issues on a regular basis. And finally, subscribe to my service on Seeking Alpha called Successful Portfolio Strategy, because that's where the things that we talk about in this channel are actually applied in practice. Thank you.